Hey guys, welcome back to FRM part 1. This is a revision video for foundations of risk management. Now in this video we are covering the first 3 readings, and in the next video that I'll be posting we'll be covering the next readings. Okay, so make sure that you are part of this journey, and if you are new to our channel, if you haven't subscribed yet, make sure that you subscribe it, and also share this revision video to your friends or colleagues, and let them also help to pass the FRM part 1. Alright, just in case if you want to get in touch with us, queries@vardeez.com. This is our official email ID and this is our WhatsApp number. Feel free to get in touch with us. Alright, so let's get started. So here we have the very first reading, and that is the building blocks of risk management. Now the very first learning objective that we have is the explain the concept of risk. So we define risk as the uncertainty of the potential losses. Now for example, if I'm running a company and if I have $1 million as my expected loss, now I wouldn't consider this 1 million as risky. I mean, it is a loss, but I can use risk management techniques to eliminate or probably to reduce the expected losses, right? I can use that. But what about losses beyond this $1 million, the unexpected losses, something that I do not know of? Well, that uncertainty is referred to as risk. Okay, so that's what we mean by risk. Now talking about risk management, these are the activities we undertake in reducing the potential losses. Now I would want to point out that we cannot actually eliminate the entire risk. There will be, when we are doing business, there will be some element of risk involved, but understand that risk management can help you to reduce the potential losses. Okay, it can mitigate the potential losses, and that's what risk management is all about. Then we also have risk taking. Now what do we mean by that? It's taking incremental risk to generate incremental gains. Now as the old saying goes, higher the risk, higher the reward. That's what we mean by risk taking. You take more risk to get more rewards. Alright, okay, talking about the building blocks of the risk management now. The very first building block is the risk management process itself. That is the first element in risk management. The second is identification of the risk. Now there are 4 categories here. The first one is the expected loss, something that we would expect while running a business. Unexpected is something that is beyond what we had expected, and now this is a major task for the risk manager, that they have to identify the unexpected loss or probably try to quantify the unexpected loss. Now there's also a third category known which is called as the known risk, unknown impact. Now over here the major task is to find what are the known risk that affects a company. For example, a bank may have a credit risk, so that is a known risk, but something we do not know is the impact. We don't know how bad would that credit risk affect. Okay, so this is something, the third category. And the final category we have is the unknown risk, unknown impact. Now what it does is that we do not know what this particular risk factor is. So how would we identify the impact of something we don't know, right? So this is the most disastrous for any organization. Okay, it's really important for a risk manager to identify what are the unknown risks as well. Okay, thirdly we have the risk interactions and relationships between them. Now it's important that now we talk about risk interactions, or many times in the FRM syllabus you will learn about correlation among the risk factors. Now this is very much possible, and I would like to give an example of Lehman Brothers. Now we will talk about this Lehman Brothers in learning from financial disasters, but just for now understand that they faced one risk, that is the market value of their portfolio was going down, so they were facing the market risk. Okay, then from market risk it quickly turned on to liquidity risk, because they were not able to sell their assets at a good price, so they faced liquidity risk. They were not able to liquidate their assets as well, and then liquidity risk quickly turned into reputation risk, because their reputation was going down and not many of their counterparties were not able to deal with Lehman. So it becomes really important for the risk manager to understand these risk interactions and how it quickly can, it can make the company go bankrupt just just happened in the case of Lehman Brothers. Okay, so it's important that we understand this building block, the risk interactions or correlation among these different risk factors. The fourth point, or the fourth building block, is the manage and monitor risk. You manage by choosing to avoid the risk, to retain the risk, or to transfer it to someone else. This is something that is the job, and monitor is something you look at the risk strategies that you've applied and you adjust if necessary. Now there's also a risk management process I've created out here. It's the identification, just what we have talked about. Then there is the analyzing of risk. You try to quantify the risk. Okay, you try to get a number for the overall risk that the firm is facing. Then you assess the impact of that particular risk, and finally you manage. You accept the risk, or you probably avoid the risk, or probably you mitigate the risk by using some strategies, or you transfer to the third party. And these are also part of the manage process. Okay, now moving on to the challenges. The very first challenge is that risk has been concentrated in the economy. Now since we're talking about the concentration risk, it's important that we understand what exactly is concentration of a risk. The perfect example is of the subprime mortgage crisis. Okay, there was a huge cluster of subprime borrowers in the great financial crisis of 2007 and 2009. So what we saw is that the major default that happened during that real estate crisis was to do with this subprime, because a lot of risk was concentrated or clustered around these subprime borrowers. Okay, so risk management, it could not prevent getting into this situation where risk was so much concentrated here. So this is a major challenge, that to disperse the risk among the participants is something that we need to do, rather than allow the risk to be concentrated. Secondly, risk management did not assist in preventing market disruptions. We've already seen this, and accounting scandals. The best example is of the Enron. The Enron case study tells us about the accounting scandals at management. They did not consider the interest of its shareholders, rather they put their self-interest above the company's goals or the risk appetite and so on, and due to this, Enron had to face bankruptcy. There was a huge scandal. We're going to be talking about that case study later. Finally, we've got the complex trading strategies while using derivatives made it difficult to assess the true risk of any position. Now what we feel usually is that when we get into a derivative contract, we are pretty much hedged, probably we are good to go, but there are some complex trading strategies, and there's also a case study regarding this, which is the banker's trust. Okay, so this case study that we have in the same Learning from Financial Disaster, it talks about wherein there's this particular hedge fund, banker's trust. They get into a complex trading strategy which led them to face huge losses. Okay, so that's something that is also a challenge here. And lastly, we've got risk management can be thought of as a zero-sum game. Ideally, we think that it is a zero-sum game, but overall, consider this: there's one person A, there's another counterparty B. Now A has transferred the risk to B. So overall, if you see here, the risk is still there. It has just been transferred to another person, but the risk is still there. Now what we feel is that we have removed the risk from ourselves, but to some other person who's accepting this risk, the risk is still there in the system. And if everyone is just posting their risk or transferring their risk to some specific counterparty, now two things are happening. Okay, the risk is still there, it's getting larger and larger, and we can see the concentration of risk to this counterparty B. And there was also an example of AIG. They were accepting all the risk of the CDS. We're going to talk about CDS. It's a derivative instrument, but they were accepting all the risk that in case of any default, they'll be able to go ahead and they'll be able to pay off the as per the contract to these counterparties who are buying the risk. Okay, so we've seen this, and it's not a zero-sum game as we think about. Okay, talking about next learning objective, tools that are needed to measure and manage risk. The very first tool that as a risk manager or portfolio manager we have is known as actually quantitative risk measure. Now quantitative, it tells us, it actually quantifies the risk measure. It gives you a number specific risk measure, that this is the number or this is the amount that you are facing the risk. So the very first thing that we have is value at risk, or VAR. Now what it does, it tells us the amount that we could lose on a portfolio with certain probability. Okay, so VAR will give you a number. Let's say there is a bank, I can calculate the VAR for a bank, and I can say that okay, the $1 million is something that is a VAR for you, so that on any given day with a certain probability you will be facing a loss of maximum up to $1 million. So that's what VAR, it gives me a number, or it quantifies the risk. The second thing is the economic capital. Now what economic capital is, basically it's the capital required to cover the potential losses. So for example, if I know that $1 million is my loss, I can keep aside $1 million as a buffer, that in case if anything happens bad on any given day, I can use this economic capital for covering up my losses. Okay, so that's what economic capital is. Then we have a qualitative risk measure. As the famous saying is that learn from others people's mistake. That's what the scenario analysis does. Now what we do is we build up scenarios. For example, what happened in the financial crisis, we will try to replicate those situations in our portfolio. Okay, and then we try to figure out the impact. Now so basically here we build multiple scenarios for a particular risk factor, and we check for the outcomes. So we are trying to develop some scenarios that what if that happened, what if the bad thing happened, what if the market goes down to a certain percentage. Okay, so this is what scenario analysis. And the other thing that we have in qualitative is is known as stress testing. Now in this we put in extreme stress on a particular parameter, and then we check for an outcome. Now what if the market goes down to 20%? That's an extreme one-day event, probably happen over a long period of time. Then where do we stand? Do we still are we still able to absorb that loss? That is something what we do in stress testing. Okay, so these are the two measures that we do in qualitative risk assessment. And finally, as an enterprise risk management, there's a chapter dedicated to this enterprise risk management. We're going to be talking about that later, but just for now, understand it means to calculate risk on a company-wide basis and not on siloed level. Basically ERM, or enterprise risk management, what it tells us is that you calculate the risk on an aggregate basis. You look at, okay, that this is the amount that we are facing at a firm. Alright, moving on to difference between the expected and the unexpected loss. Now expected loss, as we have already talked about, it's due to normal operations of a business, something that we actually expect while running a business. Okay, that's the expected loss. Unexpected loss is that may happen outside what we have expected or outside the normal course of running a business. Okay, now this is something that the major task is to identify, or to try to identify this potential unexpected losses. Now it's talking about the examples. Yes, this is the example. This is how a bank can actually calculate their expected loss. They will have all the exposure at default, all the loans, for example, all the loans that they have given out to the customers. Then they identify the probability of default. Okay, now this is probability of default calculation is something that we're going to be looking at very in much detail in level 2, but just for now understand that they calculate the probability of default and finally the loss given default. Okay, so and once they identify these three different parameters, they get their expected loss. Okay, now unexpected losses. So as an example, loan defaults at a time of a recession. No one can actually predict what could be the potential unexpected losses. Okay, just what we saw during the recession. Nobody thought that it's going to be so big. Okay, so this was unexpected loss. And also during the financial crisis, there was also correlation risk. People never expected that it's going to be a systemic risk, wherein one failure of a particular company could have an impact on the overall to the other companies as well. Okay, and that's what correlation risk it arises, which was really unexpected at that point in time. Okay, moving on to the next learning objective, and that is relationship between risk and reward. Okay, finally, risk and reward. Higher the risk, higher the reward, but there is a word of caution. One must also check for variability of the reward. One must also try to identify that if I'm taking this much risk, what if it goes beyond my expectation? Again, the expected loss comes in here. That's what variability is. And the second point to remember is it's important to break down risk factors. Try to break down risk factors. So just what we saw here, expected loss here, we can actually try to break down this probability probability of default into further risk factors, like what exactly is the financial condition of a person, what exactly is the earnings of that particular person. We can also have a look at the external factors to calculate this probability of default. So we can drill down further to calculate, or we can break down these risk factors so that we better manage this variability or the unexpected loss. Okay, so that's the risk and reward relationship. And then conflicts of interest. Understand that conflict of interest is a part of the structural changes, which is a major reason for risk management concerns. Now, structural change, for example, in the financial crisis, the banks, they started to turn their business model from buy and hold, wherein they will keep their assets, to securitization. Okay, they moved on to that. We're going to be talking about the securitization later, but understand they changed their business model structure that in part led to the financial crisis as well. And also, one potential example is the structural change is the agency risk. Just to give you an example, the board is appointed by the shareholders. The majority of them is appointed by shareholders, and the board in turn will appoint the management. Okay, so this is just take it as an example. So ideally, the board should actually work for the shareholders, but when board and the management, they are working for their own self-interest, this is known as an agency risk, because in reality, they have hired the board as an agent to work for the shareholders, but that's not happening. So that's a risk, and that's what we call as the agency risk. Then, to reduce these conflict of interest, yes, there are three things that we can do. First of all, risk recognition by employees and managers. It's really important that you feed the risk culture in every employee and the manager, so that it flows down from the management to the lower levels as well. Okay, the second thing is robust risk management system. There has to be a system in terms of risk management in place, and with supervision, so that if you are exceeding the risk, there has to be some supervision regarding that. And finally, the periodic independent audits for these two steps. That moving on, next learning objective, risk factor interactions. We've already talked about risk factor interactions about the Lehman Brothers. It's important for a risk manager to understand how risk factors interact, and how a granular or a small risk factor can turn into bigger risk. Okay, one small credit risk, it can quickly turn into some other business risk or reputation risk, or it can just turn into some other risk factor. So it's important that as a risk manager, we understand these granular or small risk factors. That's very important. Correlation among the risk factors is a specific area that needs to be checked as well. And do not forget that one risk can interact with each other. So the correlation among these risk factors, that also needs to be studied. Okay, challenges in aggregation of risk. Now, when we are trying to aggregate the risk, okay, if we are able to get one number for the entire organization as a risk, then what are the challenges in that? Let's talk about value at risk. First of all, value at risk, there are many versions of VAR. Okay, there is historical simulation, there is Monte Carlo simulation, we also have a delta normal value at risk. So there are many versions. Which one to use, that is something that we need to decide. The assumptions are also quite simplified when calculating VAR. There are only 3 parameters that you need, and you calculate your VAR easily. Okay, so it's very simplified, the assumptions are. Talking about the third point is, does not tell us how bad losses can be. For example, if any bad event happens, how bad would the losses be? There have been instances where we have seen that the value at risk was exceeded much more than what they were estimated. We have seen this. So it doesn't tell us how bad losses could be, and that is why it's one of the challenges when we are aggregating the risk exposure. Talking about other thing, the use of derivatives. Now, in options, we often use these Greeks like delta, the vega, the theta, and all those things, and we often try to get an enterprise level calculation. However, it doesn't work like that, okay, in aggregating the risk, because you cannot combine delta of one option and the delta of other option, because they do not interact together, right? We have a separate delta for a particular option, and we have a separate delta for a particular portfolio. You cannot club it together. Okay, so that is why this Greeks is also not useful when we are trying to aggregate the risk exposure. So what we can use is, we can use either the economic capital or the REROC. Now what REROC it does is, it's the risk adjusted return on capital. Okay, so basically you have the reward and you have the overall risk that the company faces, and you try to get this REROC number, and that is one way that you could actually, on a risk adjusted basis, you can get an aggregated risk number. Okay, so that's one thing that you could use in aggregating the risk. All right, moving on to the types of risk. Okay, so when we're talking about risk, there are different types of risk that exist. Let's talk about market risk first. Risk due to changes in the overall market price. When you invest in the portfolio or in the market, the risk of price going up and down, that is referred to as the market risk. There are 4 different categories. Interest rate risk is when changes in the interest rate will affect your portfolio. Interest rate going up and down, that will have an effect on your portfolio. That's interest rate risk. Equity risk is when you invest in the market, the price going up and down, that's equity risk. Over here we have general and specific. General is, for example, when the entire asset class, okay, when an entire asset class goes up, your portfolio or your individual stock will also go up. So that's the general risk. Individual stock is going down, but the overall asset class is pretty much stable. So that's a specific or a company specific risk. Okay, foreign exchange risk, you are about to receive a lot of payment from abroad. Okay, then what's going to be the amount that when you convert in your home currency, what would that amount be, higher or lesser? That's again a foreign exchange risk. And finally, we have a commodity risk. We are using a manufacturing company. We have some inputs to get. What would be the price? We don't know. So that's a commodity risk as well. So this forms the market risk. Moving on to the next type is credit risk. Risk that a person will fail on its obligations. Okay, let's get this thing one by one in order. So let's say that there is this issuer who has issued the bonds. Okay, now first of all, what's going to be the red flag for this particular issuer? The first is the downgrade risk. He may face a downgrade of the ratings. So that's one thing that the issuer will face. The second thing is the default risk. Now after downgrade, this means that the person is not able to pay off its interest or principal payments. So that is a default risk. And then finally, this issuer will file for bankruptcy. Okay, and then the last risk that we have is the settlement risk. He's not able to pay off to its creditor. Even after filing for bankruptcy, he's not able to settle it down, and that's the settlement risk. So basically, credit risk is something for a bank that it's to keep it simple. For a bank, the credit risk is, let's say they have given out loans and they are not able to pay off their mortgage loan. So that's the credit risk for a bank. And for a bond, these are the different stages that we can actually understand it in a better way. Talking about the next is the liquidity risk, not having enough money or not able to liquidate assets at a good price. Now when we're talking about liquidity risk, there are 2 types. The first one is funding liquidity. That means you're not able to fund or you're not able to get money for your operational needs, and that is referred to as funding liquidity. And trading is like you trade in the market and you're not able to get good price for your assets. That's the trading liquidity. Okay, so that's how you remember it. The other risk we have is the operational risk, and this is due to the fraud in a company. Anything internal or external fraud that happens, that's operational risk. The error done by any employee, okay, unknowingly or knowingly, that's again a risk to the operations of a company. Then a rogue trader, as I said, one person, if he deceives the company and he trades for his own personal interest, that's when we have a rogue trader. The person is going rogue basically. And the IT risk is the cyber attacks or something like that, and or IT failure, system failure, that could be the IT risk. And finally, cybersecurity is also part of the operational risk. Okay, moving on to legal and regulatory. Legal, as it signifies, it is the legal risk that a company might face due to any concerns. And regulatory risk is if there is any changes in the regulation of the business model, then this could be the regulation risk as well. Okay, talking about the business and strategic, yes, business risk is the customer demand changes, the shift in the patterns of the demand of the customer, that can have an impact on the company. The pricing decisions, if the cost of inputs goes up, there should be some pricing changes, and the pricing decision can also have a business risk. The cost structure is another point that we have in the business risk. Talking about the strategic risk, the decisions about firm's direction, how the firm needs to have its vision and how it's going to go further down the line, that's the strategic risk. It may or may not work for the company well, right? And finally talking about reputation risk, as I said, it will damage the overall confidence about the firm, and their financial soundness will also be affected, and the overall reputation goes down. Okay, so that's it for the first chapter. Let's move on to the next chapter. All right, now let's talk about reading number 2, how do firms manage financial risk. So the very first learning objective, compare different strategies. Well, the very first strategy we have is to accept or retain the risk. Now, why would I accept it? For example, if I want to have a specific exposure to that commodity or any currency, I would go ahead and I would accept it. If I'm about to receive a lot of payments from abroad, I would go ahead and I would want to take that exposure if I'm winning. So I would retain that risk. Okay. Secondly, I would avoid the risk if that is not part of my core business. If something is not part of my core business, I would try to refrain from that particular risk. Now, the third strategy is to mitigate. After acceptance, you can mitigate it or you can transfer it. You would mitigate by asking for additional collateral. A bank may ask for additional collateral to be on the safer side, and also they can charge higher interest rate because they're taking more risk, so they will charge higher interest rate. That could also be one of the ways in which you can mitigate the risk. And finally, the last one is transfer the risk to a third party with the help of insurance, or you can purchase the derivative contract so that risk is transferred from you to some other counterparty. Okay, so these are the 4 broad strategies that a firm can actually use to manage their risk exposure. Okay, talking about the relationship between the risk appetite and a firm's decision. Well, now let's introduce the idea of risk appetite. So what do we mean by that? It tells us the amount and the types of risk that a firm is willing to accept. Now here, do not confuse with the willing and the ability. Now let's learn the concept of risk appetite. Now this tells us the amount and the different types of risk a firm is willing to accept. Okay, now over here I want to make one point clear, that my ability or my willingness, they are both different things. For example, my willingness is to take more and more in risk so that I can enjoy more rewards, but do I have the capacity to absorb that particular risk or to take on that risk? Maybe yes, maybe not, it depends, right? But it's important that we analyze the willingness and ability as well, and then only we decide our risk appetite, that this much is the risk that we are taking in our firm. Okay, that's something that needs to be understood. Over here is an example. So the total capacity of, let's say, any firm is $100 million. That's the risk capacity of a firm, and the actual risk should be taken below the total capacity. Okay, so what we have taken in this example is $60 million is the risk that we have taken in an actual scenario. So this $40 million of buffer can be used in case if we face any unexpected losses. Okay, so this is how the risk appetite should be structured. This is how the actual risk should be taken down in any firm. Okay, below the total capacity. Alright, talking about the role of board of directors and senior management. So the role here is to actually communicate the firm's risk appetite qualitatively by using scenario analysis, or probably stress testing, they can use this and they can communicate the risk appetite, or they can also use quantitatively, for example value at risk, and they can go ahead and they can prepare their risk appetite. All right. Secondly, ensure that goals stated are actionable and clear, and goals are balanced between debt holders and shareholders. Now this is something that needs to be noted, that shareholders, they want the board or the company to take on more risk because they can enjoy more profits, right? And talking about debt holders, they just care about the interest and the principal payments, nothing more than that. So what the debt holders want is, they want the company to take on less risk, so that they have a consistency or a stability rather than taking on more risk. So their perspective and the shareholders' perspective, they do not match, and this is where the goals that are being set up by the board, it has to be a balance between the debt holders and the shareholders. Okay. And lastly, use stress testing to determine the loss level. So this is the role of board and senior management. All right, talking about risk mapping, now this is a collection of all the known risks that can have a potential impact on the firm. So basically what we do in risk mapping is that we write down all the risks that the company is facing. Let's say the market risk, a company is facing market risk, credit risk, operational risk, liquidity risk, reputation risk, so on and so forth. What we have learned in reading one, the company will write down all the common risks that they are facing. The benefit of doing this risk mapping is that any risk that are actually correlated to each other, that can be cancelled out, and this essentially provides a risk diversification as well. Okay, so that's the entire concept of risk mapping. Okay, moving on. Okay, the next learning objective, evaluate some advantages and disadvantages of hedging. So let's talk about advantages of hedging first. The very first advantage is that it reduces volatility of the future cash flows. If I'm using hedging, I have reduced the potential volatility of the future cash flows, and this is a great advantage. Secondly, we have a potential cash flow advantage as well. Let's say that if I get into the same hedging program, there is a chance that I may win in that particular contract. Okay, I can win. See, hedging is my basic motive, but there's also some profit that can be earned out of hedging as well. So there is a potential cash flow advantage as well. And thirdly, we have hedging. It sends a good signal. Absolutely, that's right. It sends a good message that the company has stable earnings. Now the volatility is reduced. Of course, the future cash flows are stable, right? So it sends a good signal as well. And finally, hedging makes planning overall easier because the risks are controlled. There's not much more risk, and this increases the overall performance. Okay, talking about the disadvantages, most hedging theories, they assume that there exists perfect capital markets, which is absolutely not the case. There is no perfect capital market, and there are no transaction costs or taxes, which really doesn't exist today. So that is why we can actually say that this works only in the theory. Okay, the second disadvantage is that having a hedging program may actually cause the management to lose focus on its core operations. It's absolutely true. If the management is too busy while hedging, especially in a dynamic hedging where you actually need to continuously adjust your strategy, there is a high probability that you may lose your focus on the core operations. Okay, so this needs to be taken care of. The third disadvantage is that hedging strategies will have some compliance cost as well. Okay, there may be some accounting cost as well. There has to be some disclosure that needs to be made. So it's not just that you hedge and you are good to go. There are some costs that are associated with it. And also I would like to say that when we are actually using a hedging program, we are using derivatives. Now derivatives by their very nature, they are very complex. Okay, there are some complexities involved with derivatives, and as we discussed in the advantages of hedging, that if we get into a contract, there could be a potential cash flow advantage, but let's talk about the negative consequences as well. You may even lose money on your derivative contract. Okay, so this is something that we need to understand as well. And finally, derivative pricing is not likely to reflect all the risk factors. Okay, challenges with hedging. Now, talking about this, there's always a chance that a firm might select wrong risk, or probably they miss out some relevant risk which is absolutely necessary to hedge so that the firm does not face any risk. Okay, so finding the appropriate risk factor is one of the challenge with hedging. Moving on, as we all know that price changes continuously, right? And this is our second challenge, as the market variables changes. Okay, for example, the interest rate changes, that is going to have an effect on our portfolio. The prices will have an effect on our portfolio. So keeping up with these trends is actually a challenge, and that needs to be considered also. Finally, poor communication with regards to hedging can amplify problems while hedging. Okay, the perfect example that we have here is the MGRM case study. Now over here, what they did is that they entered into a hedging program, but they could not effectively communicate their strategy to their parent company, and in the process the top management asked to close all their open hedged exposure, and they faced huge losses as part of their hedging program. Moving on to the next learning objective, what are the methods to hedge operational and financial risk? Okay, talking about operational risk, when we are trying to hedge the operational risk, we are looking at the income statement items, okay, especially the cost. Okay, that's when we are hedging that, we say that we are hedging our operational risk. And talking about the financial risk, here we are actually creating a hedging program for our balance sheet items. Okay, so that's something that we need to know. And talking about hedging the operational and pricing risk, I would say that, okay, talking about hedging operational and pricing risk, here let's first see that a firm can manage its now let's say that a firm, okay, now talking about hedging operational and pricing risk, let's first see how a firm can manage its risk of price increases or decreases. And to hedge this pricing risk, or probably the cost of inputs, okay, this is where the price are most sensitive. So you can actually lock your cost of inputs using the forwards or the futures contract. You can enter into these either of these contract, and you can lock your cost of input, so you can have a stability of pricing. Okay, that's one thing about that. Talking about foreign exchange risk, the same thing goes here. You can use the forward contract in case if you are about to send a payment outside of your home country, or if you are about to receive payment from abroad. So depending upon your situation, you can use this forward contract. When it comes to managing interest rate risk, here to protect our portfolio, we can actually use the interest rate swap. We're going to be discussing about swap later, but understand that interest rate swap is something that can help you hedge your interest rate risk. Okay, then we have something known as static versus dynamic hedging. Okay, it's a type of hedging. Either you can use static or you can use dynamic. Now when we talk about static, what it means is that you enter a hedging program and that's it. You don't track it, you don't adjust your strategy. It's just a one-time creation of a hedge, and it's like you forget it. Okay, there's no change, nothing, no adjustments, nothing like that. But when it comes to dynamic, as the name suggests, it's over here we require continuous adjustment to our hedged position. Okay, we have to manage our hedging program continuously. So that is why we say that static is less expensive and also less time consuming, but it may actually not remain a perfect hedge. In order to have a perfect hedge, we need to consider this dynamic program. Okay, and finally the last learning objective is the assess the impact of risk management tools and the instruments including the risk limit and derivatives. Now over here we have some risk limits and the instruments where the firm can actually use. Now talking about these instruments, the derivatives instruments that we have here, it's something that when we are actually implementing a hedging program, we really have to decide whether the hedging program is cost effective, what product should we use to hedge our positions. Okay, for example, if I'm using a forward contract or a swap contract, so I have to understand that swap comes under the OTC instruments. Okay, they are privately traded and it can be customized, but OTC are less liquid and certainly they have more credit risk when compared to the other type, which is the exchange traded contract. Okay, for example, in exchange traded, so they have their own predefined underlying and are standardized. They have a standardized contract, you cannot customize it, nothing like that. It's all the contract details are fixed, already pre-decided. So that's what we have in exchange traded. So as a risk manager, it's something that we need to identify what product should we use. So as an example, let's say that if I'm using this forward contract to hedge my position, then I know that price is something that is stable at the end of the contract. Okay, I know that over here at the maturity the price is going to be stable because I have already decided the price over here at time 0. But when I consider the options contract over here, now let's compare it. The forward, the price is stable at the end, but I do not have any flexibility in between. Okay, so flexibility is something that we do not have in a forward contract. But talking about the options contract, I know that at the end of the maturity here, okay, I have the price flexibility as well. I also have the flexibility that I can terminate the contract anytime in between. Okay, that is something that also exists. But then there's a cost that is associated as premium that I have to pay for purchasing these options. So a firm needs to decide which instrument should they use in order to hedge their program, and that's what these instruments are all about. Talking about the risk limits, okay, there are specific risk limit as well. And for example, if I'm using VAR as the risk limit, for example, if my VAR is breached, if it exceeds the VAR, then as a risk manager or as a chief risk officer, I'll go ahead and I will communicate to the management that our risk limit has been breached. Okay, so on and so forth. I can use these different risk limits, but then I also have to understand that if I'm using value at risk, for example, I need to make sure that the disadvantage of VAR is that it doesn't tell me how bad the losses can be on a particular day. So that's what that I need to understand. Similarly, I can use stress testing or probably scenario analysis as my risk limit, but again they also have their limitations, right? I don't know what scenarios to use, what scenarios to include, what scenarios to exclude. So I may have a hypothetical scenarios in my mind, but which one is correct, which one is incorrect, that can also lead to some consequences. So this is the last learning objective, which is assessing the impact of these risk limits or these different derivative instruments. Okay, so that's it for chapter number 2. Let's move on to the third chapter now. Alright, now let's talk about reading number 3, the governance of risk management. So this is the chapter about corporate governance, and the very first learning objective is that explain changes that happened in the corporate risk governance because of the 2007 and 2009 financial crisis. But let's have a look first at the financial crisis. So let's say that this is a diagram that I've made, and let's understand this thing first. So the bank, they give out loans to all the borrowers, and then these loans are pooled together and they are sold to this SPV. Now this SPV is also known as special purpose vehicle. This is a third party legal entity set up by the bank, and the SPV will issue the securities made out of these loans, which is known as ABS, MBS. Now ABS stands for asset backed security, MBS stands for mortgage-backed security. So the SPV will convert these loans into these different securities, and these securities are then sold to all the investors. Okay, now essentially what is happening is that the investor, they're buying this security, so the money is going to the SPV for this purchase, and the SPV has this money to buy the pool of loans from this bank. So effectively, if you look at it now, the bank, what they're doing is they're giving out loans and they're getting their money quickly with the help of this SPV, right? So overall, this is a win-win situation for a bank. They just have to give out more loans, pass it on to SPV, convert them into security, sell it to investors, and you have your money. You don't have to wait for 20 years for your mortgage payments to receive. Nothing like that, right? So it's a very good situation, and that this is the reason why in prior to 2007, banks they were just giving out loans to people with even no job, no income, with less documentation, because they just wanted to sell the pool of loans to the SPV and make a quick money out of this. Okay, but bad things happened when this financial crisis hit, when the majority of these loans, a majority pool of these loans, they actually started to default, and this is the reason why the banks suffered huge losses out of this model. Now this model that we have here is referred to as securitization. We're going to be talking about this in the next lesson, but for now, understand that this is a summary of securitization, and due to the banks profit, or I would say that making more and more profit, this actually led to in part to the financial crisis. Okay, now what lessons can we learn from the financial crisis of 2007? The very first thing is that all the stakeholders' need should be considered. It's important that we consider the needs of all stakeholders. Understand, it's not just debt holders or shareholders that we have in a bank. It's also the money of the depositors. Okay, the hard-earned money that we keep in a bank, so that needs to be protected as well. It's also the borrowers who are part of the bank, so their need should also be considered. So secondly, board should have independent and competent directors. It's always a good corporate governance practice, and remember this for the FRM exam, that in a good corporate governance practice, the majority of the board should be independent and should be competent as well, and they should also take part in the firm's risk management process. The third one is that board should clearly articulate the risk appetite of the firm to the stakeholders. It's the responsibility of the board to articulate that. And finally, compensation should be aligned properly and should not encourage any undesired risk taking. Alright, now talking about the Basel Committee and their response. So this Basel Committee, this BCBS, the Basel Committee for Banking Supervision. Currently, there are 3 Basel prescribed standards. The very first one, which is Basel 1, this was one. This one actually was created in 1988, and it actually focused on the uniform approach for capital adequacy standard. So basically, the bank, they will have to keep a certain percentage of their capital aside, so that anything happen, they can use that capital to cover up the losses. Okay, so this Basel 1 was actually focused on the capital adequacy standard. Then we had the Basel 2 actually started in 2006, and the Basel 2 focused not just on keeping capital or capital adequacy but also the bank's trading activities. They put a restriction on the bank trading activities as well. Okay, so this was the focus of the Basel 2. And then finally, what we saw after the financial crisis is the Basel 3. Now this was a direct response due to the financial crisis, and this focused on restriction of tier 1 capital. So this is a part of the total capital that a bank has. So there were some restriction that was applied to it, that you cannot use this capital for giving out more loans. You have to keep it as a buffer no matter what. So there was some restriction in terms of that. Then the Basel 3 also recommended that banks, they need to maintain liquidity coverage ratio. Now this ratio, what it does is actually it tells the bank that you keep liquid assets that can quickly be converted into cash to cover your expenses for 30 days. Okay, if anything happens, you have a 30-day window period wherein you can convert your liquid assets and you can get cash for that. So that at least you are able to survive for the next 30 days. So that's what we mean by liquidity coverage ratio. And then there was another ratio, which is the net stable funding ratio, NSFR. Now this is something, what it tells us is that it advises the bank that to keep assets that will cover the funding needs of up to 1 year. So for 12 months you are able to survive with the help of this NSFR, which is net stable funding ratio. So this was a direct response after the financial crisis, and these were the advices that came with the Basel III. Okay. Other thing that happened apart from the Basel was the DoddFrank Act. Before we understand this DoddFrank Act, let's understand prior to DoddFrank Act in 1999 there was this Glass-Steagall Act which was in place, which actually separated the commercial bank and the investment bank. But then this was actually abolished in 1999, and this Graham-Leach-Bliley Act was formed, wherein the commercial bank and the investment bank as well as a broker dealer, they can all function under the same roof. They were actually combined. Okay, and this was partially one of the reasons why the major investment bank like Bear Stearns and Merrill Lynch, they were in such a distress mode that they needed to be merged into some larger financial institutions, okay, because of this act as well. And after the financial crisis, this Dodd-Frank Act was actually enacted to address several issues related to the protection of the consumers and to have some market stability. So the very first thing that was under this act was to strengthening the Fed, basically giving more regulation to the Federal Reserve. That was the entire objective, so that they can regulate the most important financial institutions. Secondly, the ending the notion of too big to fail. Like Lehman Brothers, they thought that they would not be able to fail because they were too big. So they wanted to end this notion that even bigger companies can actually fail. The third thing we have is a resolution plan, that all the important financial institutions, they should have a resolution plan. In case anything happens, they should come back to solvency. That's something that is also part of the Dodd-Frank Act. The derivative market is something that it wanted to create more transparency in the derivative market. The next we have is a Walker rule. They put some restrictions on the bank trading activity. Then there is consumer protection. This goes without saying that consumers need to be protected, the investors need to be protected, and the market has to be much more stable. And finally, some stress testing that was designed as part of the Dodd-Frank Act. Okay, next learning objective, what are the best practices in the corporate governance as well as risk management? So as I said, board should have majority of independent members and competent as well. This is the very first best practice, always and always. The second thing we have is that board should take into consideration the needs of all stakeholders, just what we have learned in the lesson. Compensation should be aligned with corporate goals and reducing the agency risk. Managers should not take more and more risk just to get more compensation, so it should be aligned well. Board should be aware of the agency risk. There is a chance that management may work for their own self-interest and probably do not consider the interest of the shareholders. So the board should be aware about this agency risk. Then board should maintain independence from the management. This is a very important point, guys. Remember for the exam that the CEO and the chairperson should be two different individual. Okay, the CEO and the chairperson should not be one, because if that is the case, then there is a chance of conflict of interest. Okay, so remember this point very well for the exam, and consider the introduction of a role of a CRO. Now CRO is the Chief Risk Officer. Okay, one person who will actually report to the board. So this role of a CRO is also the best practices that is there in the corporate governance. Okay, talking about the best practices in risk management, clearly articulate and communicate the enterprise level risk appetite to the stakeholders. That is something that is the best practice. Board should strive for economic performance as compared to the accounting performance. Okay, this is also important. The overall economic performance is always matters as compared to the accounting, because there is always a possibility that accounting numbers can be inflated. Okay, so that's why economic performance, the true position of a company always matters. Okay, and then finally establish a risk committee. Risk committee is something that will be a subset of the board. Also have an independent audit committee. Okay, we're going to be talking about the audit committee as well. The audit committee should be independent, and a compensation committee who should be independent from the management. Okay, if the compensation committee is from management, of course they will give more payments to management. So this is something that we need to take care of. The compensation should be a different committee and should be independent. Should not get under pressure from the management. Okay, keep this in mind. All right, next learning objective: assess the role and responsibilities of the board of directors in risk governance. Now, what are their role? Very firstly, it's important that there has to be a risk advisory director for all the complicated matters of risk management. If the board is not able to understand that, risk advisory director is the person that can be approached by the board member. Okay, so this person, risk advisory director, would be a board member itself, who is a risk specialist who attends risk and audit committee meetings and can advise the board on the specialized risk exposure, because he has the knowledge about risk management. So he's going to be the part of the board member, and he can advise the board on risk issues. Okay, then we have a separate risk committee. This is also part of the board of directors, and their job is to set the firm risk appetite and monitor any ongoing risk management. Of course, risk management will be monitored by the risk committee, and there's also going to be a role of the CRO, the chief risk officer, who's going to be handling the risk management as well. Then finally we have the compensation committee. Now, existence of the agency risk necessitates a board to implement a compensation committee. Now, we already talked about the agency risk due to management taking more and more risk just to get more compensation. It's always advisable that the committee is separate, the compensation committee is separate from management, and align compensation with long-term stakeholder needs. Okay, this is something that needs to be done. The same thing that we've talked about in the corporate practices. Moving on to the next learning objective: relationship between a firm's risk appetite and its business strategy. Now, risk appetite, it shows the tolerance or willingness to accept risk. Basically, with the help of risk committee, the board will set up enterprise level risk appetite, just what we have seen here. As I said, CROs, they are also part of the risk committee, and they are responsible for the day-to-day risk supervision, and they are actually in a position to approve risk limit breaches. Now, for example, if the risk limit is breached, the CRO role will come into play, and they will advise that what next needs to be done. And as I said, that there may be times when management will have opportunities that can actually be good for their overall business strategy, but the risk appetite may not allow or approve to exploit such opportunities. Now, in that situation, what can be done is that CRO, they can reach out to CRO, and the risk committee will take a decision whether to take up that particular opportunity or be in alignment with their risk appetite. Okay, moving on to the next learning objective: illustrate the interdependence of the functional units. So how it flows down is from the senior management, they will set up the business risk tolerance, they will set up the risk appetite, they will pass it on to the business line or business units. Then this business line, they will manage the approved risk policy. Okay, what was the policy that has been approved? They will go ahead and they'll manage that, and they will also identify any exceptions to the risk appetite or any business risk tolerance. Any exceptions to that, they will note it down, and then it flows down to finance and operations, wherein they will go ahead and they will actually use the risk mitigation strategy. They will execute that, and any transfer techniques they will use, any derivatives like that, and also they will assist in risk and business planning. And it moves further to the risk management. Now the job of risk management is to monitor the risk limit, see whether the risk limit has been breached or not, managing the risk management process, and communication with the senior management. They will let the senior management know about any breaches of the risk limit and so on, and they could advise on the risk management. So this is how it actually flows, and then finally the senior management will evaluate the performance based on this interdependence. Okay, so this is what the learning objective is, the interdependence of these different functional units within a firm. And finally, the last learning objective is the assess the role and responsibility of a firm's audit committee. Now, as I said, there has to be one independent audit committee and the internal audit function as well that exists in a firm. So the audit committee should largely be independent of the management, okay, so as to prevent any conflict of interest. Always and always make sure that the board, the compensation committee, the audit committee, they should be independent of the management. However, they should work closely with management to address any issues that come up. Okay, this is something that needs to be noted. Members should be knowledgeable enough, they should be competent enough. This goes without saying. They should have the knowledge about accounting and on all the accounting standards. Okay, this goes without saying. They are also responsible for accuracy of the financial statements. They should monitor the financial reporting, any regulatory compliance that comes up, internal controls, and also risk management. Okay, so this is also the responsibility of the audit committee. And the internal audit function that a firm will have, they should be responsible for monitoring the risk management procedures. They can also offer their opinion on reliability of any risk metrics that has been estimated. For example, if VAR has been estimated, they can offer their opinion on that. They can offer they can suggest some assumptions used in the internal risk which has been estimated. They can offer their opinion on that. Okay, so these are the roles of the internal audit function that exist in a firm. Okay, so with that being said, we are done with the third chapter.